99% of traders online focus on technical analysis, but I believe that fundamental analysis is the most overlooked and underutilized tool when it comes to trading. Far too many traders are looking at the charts when they need to be understanding what's actually going on in the real world. And today, we're going to be discussing the foundational element of fundamental analysis, the one tool, the one concept that every other fundamental analysis concept is built upon. And when I learned this, my trading completely transformed. But not just that. Once I learned this concept, I was never able to look at the market the same way. After spending over $10,000 on Forex courses to learn this specific concept, today I'm going to teach you for free. Okay, so the foundational element that all of fundamental analysis is built upon is what's called a market sentiment. The idea that the market is feeling different things, the market is a moody beast, and depending on the time frame, it is feeling something different as opposed to another time frame. We will get into that. But basically, what you need to know is that the market is always fluctuating between risk on and risk off. And when I mean the market, I mean investors, hedge funds, banks, institutions, even retail investors. Their sentiment, how they are feeling, fluctuates. At times, when the market is what's called risk on, means everything's good, the vibes are high. Investors are looking to take on risks, and therefore assets that are considered riskier are going to strengthen. Alternatively, when things are bad, think COVID 2020, which we will get into. When things are bad, risk assets are going to fall, but safe haven, risk off assets will strengthen. Now, many of you watching this are specifically Forex traders, and so we're going to break this down exactly how it applies to Forex trading, but you need to understand that regardless of what asset class you are trading, this applies. Every single asset across the board falls into a certain category of how the market views it, how risky the market views it. Some assets are safe, some are risky, some are neutral. And in order to make the best possible trading decisions, you need to understand what the market is feeling and then apply it to the asset that you are trying to trade. If things are good, you don't want to be buying and flowing into the US dollar, the Japanese yen, the Swiss franc. You want to be flowing and buying assets that are also riskier. When things are good, investors are looking and willing to take on more risk. Therefore, risk assets will move higher. So I digress. Let's back up. Let's take it slow, step by step, and let's see how this applies specifically to Forex trading. First off, quick announcement. We have a gentleman's agreement on this channel. We provide tons of value for free. In exchange, you just hit that subscribe button. 88% of you watching. 88% of you watching are not subscribed. It's just one button, so please, it helps us out a ton. Hit that button. Okay, so we're going to break down this concept specifically for how it applies to Forex trading from one lesson in our free fundamental analysis course. We are building out a school community. This is going to be a community for free that will massively help traders. Our goal is to help traders master fundamental analysis. I am obsessed with fundamental analysis. It is my passion. It is what I love diving into. I love understanding what the market is doing, how it functions, and all that type of stuff. And so this is a lesson that is in that course. You can join down below completely free. Okay, so when it comes to risk off, risk on, and neutral, some people say I talk too quick, so I'm trying to slow myself down here. We have three categories: risk on, risk off, and neutral. And each currency falls into one of these three categories. So let's take it step by step. Our risk on categories are the Australian dollar, the New Zealand dollar, and the Canadian dollar. This means that when things are good, typically when the stock market is moving up, when things are good, there's not a lot of fear in the market, these three currencies are going to strengthen. Now the question is, why is that? Well, if you are not completely new to this concept, these three currencies are what we call commodity currencies. These three currencies and countries are heavily dependent on commodity exports. For example, the Canadian dollar is heavily dependent on the price of oil. When the global economy is healthy, there is a higher demand for oil. Therefore, Canada can increase its oil exports, and that makes the desirability and the demand for the Canadian dollar more. All right, so it strengthens the Canadian dollar, okay? Alternatively, when things are not going well and when the global economy is suffering, there is less demand for these commodity-based currencies, okay? So keep that in the back of your head, very important. Risk-off currencies. So when things are not going well, think again, COVID 2020, which we'll get into. When things are not going well, there's a lot of fear, stock market's crashing. We see outflows from our risk on currencies and we see inflows to our risk off currencies. These currencies are viewed as safe havens. Specifically, we have the US dollar, very obvious one, global reserve currency. A lot of investors around the world are going to flow into the US dollar. Secondly, we have the Japanese yen. Not a lot of craziness coming out from Japan. Very stable country. Japanese yen is quite stable, very low inflation. And the Swiss franc, obviously the Swiss being the Swiss, it is a desired currency. So we have those. Now our neutral currencies. I want you to remember that neutral currencies, these can fluctuate depending on what's going on in these countries, what's going on in the market. A neutral currency can sometimes be in the risk on, risk off, or it can just be neutral. We have, as of this recording, the euro and the British pound in the neutral currencies. Why? The euro doesn't really have the safe haven status that the US dollar does, and the British pound, while historically has been a safe haven ever since Brexit, that is questionable. So at times, yes, there'll be inflows to it for safety, but for the most part, I view it and I trade it as being neutral. This, put it bluntly, needs to be burnt into your brain. Moving forward, you are not going to take a single trading decision without understanding market sentiment and applying that to these currencies. For example, if the stock market is ripping higher, as I said, you don't want to be buying the Japanese yen, okay? Secondly, so you know you're going to burn this in your brain, you're going to apply it to all trading decisions. This is kind of a bonus tip. To catch the most amount of pips, to avoid the painful days of a currency just moving sideways, not going up, not going down, not being able to catch any pips. To catch the most amount of pips, you want to combine one currency from one category with a currency in a completely different category. For example, you want to trade the Australian versus the US dollar, Aussie US. You do not want to be trading Aussie New Zealand. I see so many traders trade this and it blows my mind that they don't understand this concept because they are shooting themselves in the foot. They could be making their lives so much easier, but they're not applying this, okay? So you want to be applying two currencies from two different categories. Okay, so now it's time to actually put this into action. You need to burn this into your brain. If you still don't understand it, rewatch the video from the beginning, but we're going to give some specific examples for how this applied historically and how you could have made a ton of pips. And you're going to make a ton of pips moving forward because you understand this concept. I like to look at COVID, March 2020 specifically, because it's still recently in our memories and because it was such an obvious negative news event, obviously, and what happened after, because once all the fear dissipated, we had a massive bull run in the stock market, and so I like to apply that exactly to our currencies so we can see how they move depending on risk sentiment. Okay, so starting off with Aussie US, which as I mentioned is a great pair to trade because the Australian dollar is a risk on currency and the US dollar is our safe haven. So if we go over here to March of 2020, you can see a very obvious and a very clean sell-off in this pair. We dropped roughly 1,000 pips or 17-18%, which is a huge move in the Forex market. This is obvious. Times were bad. Everyone wanted to flow into the US dollar. The dollar was king. Nobody wanted the Australian dollar. So boom, very obvious trade. So now you can say to yourself, moving forward, oh, major negative news event, there's going to be outflows from the Aussie dollar and inflows to the dollar. I don't want to be buying it, right? Every retail trader that was trying to buy the dip, they didn't understand fundamental analysis. They didn't understand the concept of market sentiment, okay? But once everyone realized that people weren't dying in the streets, that it wasn't airborne Ebola, I think we're allowed to now say that on YouTube, what happened in the stock market? Well, it went on an absolute tear. It was incredibly bullish, which means market sentiment shifted. Therefore, investors, retail traders, institutions, banks, you name it, were looking to take on risk. That meant there were outflows from the dollar, no more dollar holders, and flows into risk on assets such as the Australian dollar. And you can see here we had a move from the lows all the way up 42%, 2,300 pips. Insane move. Speaking of stocks, I want us to see and look at exactly what happened again in 2020. Whether you trade stocks or not, you need to be following the stock market. This was again a huge tool to add to my repertoire because it's really difficult to develop an understanding of risk sentiment without looking at what's going on in the equities market. So, as we all know, 2020, we had a huge sell-off in the S&P 500, 34%. But again, after that, we went on a huge tear. So, risk sentiment, times are good, risk on assets are going to fly, aka stocks, and you can see that here. We had a huge move up in the stock market. Had a little bit of a correction here in 2022, but again, now we are back at all-time highs. Another very important tool to look at in relation to trading, risk sentiment, stocks, you name it, it is really difficult to be trading without following the dollar index, the DXY. Again, the dollar is king. It is the global reserve currency, and in order to understand what the market is sensing, we need to be looking at the dollar. We understand that the dollar is a safe haven, so anytime the dollar is going up, we know that there could be something going on. It's not guaranteed, though, as we're going to see. Okay, so we see here, 2020, March, we had a huge, clean 2-month move in the dollar of 8%, but then after that, we had outflows dropping roughly 12, 13, 11% or so from all-time highs. Again, this correlates perfectly with the stock market. I want to ask a very interesting question. Because again, this isn't always, trading is not simple, it's not easy, and so it's not always a perfect correlation. So ask yourself, what went on here? Starting at the bottom of, June 2021, why is it that when stocks were hitting all-time highs, we had the dollar surging? Well, think about it for a second. The answer is very straightforward, and it's something that we cover extensively in our school community. It's obviously inflation. If you were buying groceries in 2021, you probably started to notice, things are starting to get a little bit expensive. And around that time, the central bank, the Federal Reserve, began hiking interest rates at the fastest pace that they have ever in history. And now, interest rates are the highest they have been in several decades, okay? And as we cover in the course in the community, higher interest rates lead to a stronger dollar. So that's why we had this here. So again, it's not a perfect correlation. You need to understand everything that's going on in the market, because while stocks were surging, your bias might have been, let me short the dollar. That would have made sense. But if you weren't looking at the whole holistic picture, you would not have caught that interest rates were rising, and that's going to lead to a stronger dollar. Bringing it back to our currencies, we're going to go back to 2020. Again, we're now looking at CAD yen. Again, a great pair to trade because we're combining both a risk-off currency and a risk-on currency. So we had a move here of roughly a drop in the Canadian dollar of roughly 10-11% at 12% March 2020. And again, when that fear dissipated, we had a strong move in the Canadian dollar, being a commodity currency, strong demand for oil, less demand for that safe haven Japanese yen. So we had this huge bull run in the Canadian dollar versus the yen. Now, Japan, again, you need to be following what's going on there. While there is very rarely any market-moving news coming out from Japan, they have recently removed themselves from their negative interest rate policy, which has caused a lot of commotion and a little bit of volatility. So that's something that you're going to want to look at. Okay, so we have learned in this video that the market always has a sentiment. Now, it's important to understand that sentiments can vary depending on the time frame. Something could be bullish on the weekly chart, but bearish on the 1-hour chart. And you need to always be understanding and being in tune with the vibes of the market to make the best trading decisions as possible. But we have learned that there are risk on, risk off, and neutral currencies. And in order to make the best trading decisions, we need to apply that to what's going on in the real world. Again, the market isn't moving 1,000 pips because it hit some trend line. It's moving 1,000 pips because of something that is happening in the real world. And every single fundamental analysis tool is built upon this idea that the market is sensing something, the market is feeling something, the market has a certain demand or distaste for certain assets, and that is what's going to drive the market. And so once you know this, hopefully you do now, you'll never take another trading decision the same way. You'll now open up your laptop in the morning and you'll ask yourself, what is the market feeling? What's going on in the world? What is the most pertinent piece of news that is driving markets? I'm recording this June or May 2024, and right now the market only cares about two things. It cares about inflation rates and interest rates. When inflation drops, that means interest rates will be able to be cut, and that is going to drive the market. That is going to potentially drive up risk assets because lower rates are good for the economy. But that's assuming there's no major recession and that type of thing. But again, hopefully you can tell that I am obsessed with this, and I am obsessed with fundamental analysis because it transformed my trading. Without it, I would not have been able to quit my job and trade full-time for 2 years. It's this lesson, upon with countless others, that we are including in our free school community. We are helping traders master fundamental analysis. Again, I think it is the most overlooked aspect in trading. Forget your technical analysis. Don't forget it. It's still very important, but fundamental analysis is so important. And so if you got value from this, subscribe, please. 88% of you watching are not subscribed. Join our school community down below. Come say hi to us. I'll be more than happy to help you out. And of course, if you have any questions, drop them down below. I hope this transformed your trading. It should. Don't look at the market the same way anymore. See you in the next one. Peace.